What's up everyone, it's Scotty with MoneyVest. So in today's video, we are going to be talking about the very important employment numbers that are coming out this week. In fact, today we've got the JOLTS numbers coming out at 10 a.m. Eastern. So very important numbers for the market and for the economy, because this is really what's going to dictate how the Federal Reserve kind of plays it moving forward with respect to interest rates. So hope you all enjoy this video and find it helpful. Make sure that you drop a like and don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join. And of course, you get access to all the members only private videos. There's 40 plus private videos going over a lot of really interesting and educational stuff. Full access to all spreadsheets, including intrinsic values, S&P 500 valuations, volatility spreadsheet. Everything's going to be included, as well as the Discord access with over 20 plus channels, including trade alerts and ideas and profit and loss channels and a lot of other stuff as well. So link's going to be down below. We'd love to have you on board. We do have a few more spots opened up for the month of December. And also do check out the courses down below for fundamental, technical analysis, options, and psychology. 120 plus lectures, lifetime access, and 30 plus hours of content. And do connect with me on Instagram as well. My handle is going to be CASWRP. I do post a lot of interesting stories, posts, polls, strategies, videos. Everything's going to be included there as well. So link's going to be down below for all of these things. We'd love to have you on board. So this right here is the JOLTS numbers expectations. 9.4 million is going to be that consensus. Now, why is this such an important number? Because this basically tells us how many job openings there are in the United States. And if you go over to my spreadsheet, we've talked about this before, that JOLTS numbers represents the supply of jobs. Unemployed persons represents the demand for jobs. In other words, how many people are currently unemployed. And these right here are the two building blocks for any labor market, right? So for example, if job openings continues to go up, that means more and more businesses are hiring or putting up these job offers and openings in their organization. So if, let's say, for example, this number gets up to over 12, right? All of a sudden, we now have a lot more job openings relative to unemployed persons. And this ratio, which is what the Federal Reserve tracks very closely, continues to go up. On the other hand, if this number starts to go down, that means businesses are hiring less. And if you take a look at the consensus, 9.4 million. So if you plug in 9.4 here, this number will go from 1.47 to 1.44. We'll also get the unemployed persons report on Friday. It's the first Friday of the month. So if, let's say, this number gets up to over 7 million, right? So if this number right here from 6.5 million increases, let's say 500,000, and we go up to 7, now we're looking at a ratio of 1.34. What does this tell us? The lower the ratio, the worse the economic condition would be, or the worse the labor market condition would be. The higher the number, the stronger the labor market condition is. And this number has been coming down from well over 2.5, now down to 1.44, considering how much tightening we have seen in the economy on the back of interest rates going up from Federal Reserve. And as a result, there's been a better and better equilibrium with respect to supply and demand for labor. So 1.44 is where we currently would be expected to be, considering a 9.4 million print on the JOLTS number. And this right here is going to be the expectation for ADP, 123,000 jobs added in the month of November. And this is going to be the employment situation with non-farm payrolls month over month at 180,000, with unemployment rate sitting at just a little bit under 4%, with private payrolls 150,000, manufacturing payrolls 35,000. In fact, prior number was a negative 35,000, right? So we did see a contraction in manufacturing payroll. Two things: construction workers and manufacturing payrolls. These are two very important subsets within the overall employment report, because it tells us how well the economy is doing or how well the economy could be doing in the future, because these are the two building blocks of any economy, construction and manufacturing. If those two industries come to a halt, that leads to potential contraction in the economy. So those are two subsets, like I said, of within the labor market report that we need to understand and watch for. Average hourly earnings expected to increase 0.3% year over year at 4% and 34.3 hours of work week. And again, this right here is going to be a very important number at 1.44. And Jerome Powell and the Federal Reserve has already mentioned that they want this number to come to an equilibrium of 1. We have come down from 2.5, even at one point during the pandemic and after the quantitative easing measures, we did see this number get up to as high as 3. So we're coming from a very significant and resilient labor market to now somewhat, some weakening in the labor market, but more towards the equilibrium side where both JOLTS and unemployed persons kind of match each other eventually. Now, this right here is, again, that unemployed persons. We are sitting at the most recent report in October, 6.5 million, and unemployment rate continues to be, again, sub 4%. That's exactly, what the Federal Reserve wants it to be. Like, that's exactly where the Federal Reserve wants the unemployment rate to be, at sub 4%, because this right here is the dual mandate from the Federal Reserve. And you'll notice that the main target from the Federal Reserve is 2% inflation and just a little bit over 4% unemployment. So there is maybe more potential for us to see a bit of an increase, and you can see that we have been going higher, right? So we were back in January of this year, April and March of this year, we were sub 3.5%. We have been climbing up slowly and steadily, and all that is happening on the back of rising interest rates. And of course, it's not the fact that interest rates are going up that's a problem. It's the fact that they're staying up for longer. That's the problem, because of the time lag effects that we've talked about. And as a result, it's possible that the Federal Reserve welcomes some weakness in the labor market as well, as they try to achieve their objective of bringing inflation back down to 2%. So currently we are over here. So as I've already mentioned in my previous videos, so if you take a look at the dual mandate from the Federal Reserve, we are most likely right now at around here at these levels. So inflation's high, of course, but unemployment continues to be really, really low. So this is where we currently are. The Fed's target is to bring this dot to the target range, which is 2% inflation, a little over 4% unemployment, and they're doing that on the back of rising interest rates. So if interest rates continue to go up, as they have been over the last 12 to 18 months, and they stay higher for longer, well, then there's three scenarios that the market and the economy could basically ends up in, right? So these are three scenarios I've talked about in my yesterday's video, where there is a soft landing, where inflation comes down and unemployment stays low, which is the best scenario for the market and the economy. So inflation eventually comes down and unemployment stays as low as it is. The second scenario is a hard landing, where inflation comes down but unemployment goes up, right? So we are moving down on the y-axis, moving right on the x-axis, and where inflation's down, unemployment's higher, and as a result, the Federal Reserve would then need to cut rates to bring unemployment also back down to their target range. And the last scenario would be going not here, but going all the way down up here in the top right, where both inflation and unemployment stays elevated. And that's going to be the biggest problem the Federal Reserve's faced in modern history. So that obviously is a scenario that none of us want. We don't want to go into an environment where both inflation and unemployment stays high or starts going higher, because then the Federal Reserve will be fighting against their dual mandate. And they will have a very big dilemma on whether to raise rates, cut rates, support inflation, support the economy, support unemployment. It'll be a pretty big mess. So that's really where we are with respect to the current situation. And the market continues to price in 5 rate cuts, now starting in even sooner in March of 24. So the market's only pricing in 2 more meetings where the Federal Reserve keeps the rates steady, and then starting March of 24 is when the Federal Reserve basically is expected, according to the market, to embark on this journey of rate cuts, and 5 rate cuts are priced in right now from the market, which does open the market up to huge amounts of repricing risk. And this is something that I've been voicing for quite some time, because if the market's pricing in 5 rate cuts and we don't get 5 rate cuts, we get 2, maybe we get 3, maybe we get 0, well, that's the vulnerability, that's the threat the market right now carries, because there's a lot of expectations baked into where the prices are at the moment. Something to keep in mind, and that's where we are. Let me know in the comment section below if you have any questions. Hopefully this explains the situation a little bit better. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel, and of course links to our Discord and Patreon and courses and Instagram. Everything's going to be down below if you want to join, of course, be a part of our Money Invest community. And as always, happy investing, and I'll see you all in the next video.